Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 24th of March. I'm Daniel Lam, your host for the podcast. I love reading charts, but you really do not need special training to see that the charts for many of the key stocks and assets are technically bearish. But it certainly feels that there is an excessive amount of stress and nervousness out there. And I believe after a certain amount of time, we will all be looking back to March 2026 and say that this was a buying opportunity. But like a trader friend of mine has once told me, that the markets can stay irrational longer than one can stay solvent. Now, as obvious as it sounds, in order to restore the rationality, you need the Middle East tension to de-escalate. However, what is worth highlighting is that with the exception of the Libya crisis in 2011, stocks were under the heavy influence of energy prices in every single geopolitically driven oil shock over the past 15 years, until WTI returns to its pre-event levels. Now, this really underscores how potent the influence of a stressed out oil market has on global equities and risk sentiment in general. What makes the situation more complicated this time was the experience of 2021 to 2022, where the Fed was slow to react to the impact of the Russia-Ukraine conflict. This time, the long-dated bond market is repricing fast, with yields going higher at the FOMC meeting last week. Does this mean that we are doomed? Well, not exactly. For one, the FOMC last week had a hawkish tilt. But what if the Fed were to deliver a less hawkish stance? That would alleviate some of the market stress, even though it is tough to see how much the Fed can deviate from its data-dependent mode. Now, the other way is to have more flushing out of investor positioning, similar to what we saw during Liberation Day. Now this, I would quote again the term clarity factor, which I spoke about very often last year. Remember that the S&P 500 has recovered beyond the loss it experienced by May 2025, even though prevailing tariff rates at the time were expected to lower 100 basis points of US output in the coming quarters, exactly because things have clarified. In contrast, a sustained run of $100 oil would reduce US GDP by roughly 50 basis points, which is half of 100 basis points. So right now, US equities positioning is slightly below neutral. So there is potential for S&P 500 to correct further. For example, going to test the support zone around 6,150 to 6,300. But investors should not be overly pessimistic at this stage, especially in the structural growth areas in US semiconductors and AI infrastructure stocks. That's all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.